Canada's inflation rate has hit 8.1%. Is this the peak? In today's video, I'm going to explain some of the data behind the most recent Statistics Canada inflation report, and I'm going to share how inflation affects investment decisions. So if you are investing, or even if you have cash that you are saving, how this inflation report is going to affect you. So let's get into it. So you can see here, we've heard a ton of headlines recently. Canada's inflation rate hits 8.1% in June. Primarily, gasoline prices were a big contributor. They are up 54.6% year over year. Transportation is up 8.2%. And a big factor is that Statistics Canada has added prices for used vehicles into the CPI. Food prices were up 8.8%. And even when setting aside gas and food prices, inflation was still 5.3% in June. So that is very interesting. Even without gas and food, prices are still up 5.3%. These are the highest readings since January of 1983. The inflation rate in May was 7.7%, so it is increasing further. However, this current 8.1% inflation reading is less than the consensus estimates, which the market was expecting it to go up 8.4%. So in a way, it is less than expected, which is good. However, it is still quite significant. So as most of you probably know, the war in Ukraine is affecting a lot of the factors that go into inflation. This article is stating that the war in Ukraine has led to the largest commodity price shock since the 1973 oil crisis. So you can see in this chart how much oil prices increased in 1973 and where we are at currently. A lot of commodity prices have increased, and you can see in this chart, compared to the pre-war forecast, the current price increases are quite staggering. So energy is a big one, but even fertilizers, oils and meals, base metals, grains, and even something like timber that's down 4% was significantly up in the year prior due to COVID. So we've had now a few different factors that have affected commodity prices. This is something I found interesting. So Benjamin Tal, the deputy chief economist at CIBC, is sort of reiterating that same statement. The war in Ukraine, continued deglobalization are inflationary. Economies are experiencing an oil shock, but he believes that 60 to 70% of the inflation is caused by supply chain issues and a sick supply system. So something interesting to consider. We may not see 8.1% inflation continuing. This may be only for a relative shorter period of time. That is what the Bank of Canada is hoping for. But even removing oil prices, things are still up 5.2, 5.3%. So something to consider. I went back to an article that was written by Warren Buffett back in 1977, where he wrote about inflation, how it swindles the equity investor. And this was an interesting portion that I found. What widows don't notice. It makes no difference to a widow with her savings in a 5% passbook account, kind of like a savings account, whether she pays 100% income tax on her interest income during a period of zero inflation, or pays no income taxes during years of 5% inflation. Either way, she is taxed in a manner that leaves her no real income whatsoever. Any money she spends comes right out of capital. Basically, what Warren Buffett is saying is whether you have an income tax or an inflation tax, if you are not earning a rate of return above inflation, you are essentially spending the money that you saved. You're not spending the interest. So if we take a look at the current interest rates, so RateHub has a has all the different savings accounts provided by different financial institutions. Right now, EQ Bank has the highest non-promotional interest rate of 1.65%, and many of these other banks are promotional rates, I believe, but in the 2.8, 3%, 2.25, 1.8. Even if the inflation rate is not 8.1%, but if it's 5.3%, you are still losing money to inflation by having cash in the bank. But right now, having cash in the bank feels a lot better than having money in the stock market. So the S&P 500 year to date is down 17.4%. And if you really look at that return, if inflation is 8% and you lost 17%, you have a quite significant loss of your purchasing power. Even if we look in the housing market, so in Ontario, prices increased dramatically since June of 2020, when due to COVID, low interest rates, everything, house prices dramatically increased. And then since the beginning of the year, prices have also been coming down. So if you own real estate, or if you bought real estate, especially in January and February, you're probably not feeling too good right now. The one interesting thing that I personally found, looking back at history, back in 1971, so this is in Canada, the inflation rate was at 2.1%. It spiked in 1974 all the way up to 11%, came down a little bit, and then continued further in 1981 and peaked at 12.4%. What happened to interest rates during this time of high inflation? As you probably guessed, interest rates also rise. So in 1973, interest rates were around 9%. They increased all the way up to 21% as of 1981. So inflation went to 12%, interest rates went to 20%. What do you think happened in the real estate market in 1981? So if we look at the Toronto average sale price data, the historic statistics, in 1981, the average sale price in the Toronto MLS system, so basically the sale price in Toronto, the average sale price was 90,000. It then increased to 95,000, to 101,000, to 102,000, and continued increasing until 1989, where it peaked at 273,000, 3 times the price it was when inflation and interest rates peaked. That is really counterintuitive. Why would real estate prices increase when interest rates have just hit 21%? And even in the period prior to inflation increasing and interest rates increasing, house prices increased from 1976 close to 50% leading up to 1981. Again, my belief around this time, and I'll have to do more digging into it, is that real estate was viewed as an asset you could own to protect yourself from this inflation. And on some level, even though interest rates rose to 20% and subsequently inflation decreased, people's expectations probably were that inflation would continue despite the high interest rates, and that real estate was a place you could protect your savings, your capital, so to speak, and earn an income that was inflation hedged. So around this time, probably rents would have increased along with inflation. Prices did come down, however, from 1989 all the way to 1996. They peaked at around 273,000 and dropped to 198,000. This was about a 30% decline. But if you look at how prices reacted even the 2 years prior to the peak, it only decreased back to prices in 1987. So if you bought a home in 1987, it would have increased, decreased, but you would still be in the same place that you bought your home. So as long as you didn't refinance your home right at the peak and take money out, you would really be fine. It's only the people that bought in 1988 and 89 who would be underwater on their mortgages. So what does all of this tell us? The history is a good way to learn about how different things interact, how interest rates, real estate prices, inflation interact. However, the past does not repeat, it rhymes. So we can learn from it, but we cannot expect it to happen exactly how it did before. My takeaway from this is that I want to have cash in the bank because when asset prices drop, it protects my ability to continue to invest during times when prices are low, and also just it gives me peace of mind. However, cash in the bank is going to lose value relative to inflation, so it's important also to own assets that can produce during times of inflation, assets that can increase in value with inflation, and for example, a rental property that has rental income that can increase when inflation rises. We are in a new period of higher inflation, different to the last 15 years. So we need to readjust our expectations and our investment decisions. We need to make decisions based on the current, not on what we just experienced over the last 15 years. So hope you found this helpful. If you are interested in investing in real estate, my real estate team helps investors buy and sell rental properties. You can get our free beginner's guide to investing in the Niagara region in the link below. If you have any questions about anything I mentioned during this video, feel free to comment below. Until next time, all the best.